Hi folks, this is Craig, the Options Linebacker. This is the weekend report for Sunday, April 18th. Let's start out this weekend's report by looking at the S&P 500 on a monthly and weekly basis. I like to use the S&P 500 because frankly I found that it's the best chart that's out there in terms of determining what the actual supply and demand is of the United States stock market. I think it's a much better index than something that's a little more thin, such as the Dow 30, there's only 30 stocks there, or versus the small cap like Russell 2000 where we're just getting one side of the market. I think the S&P does the best job of showing the US market overall, and it certainly has got tons and tons of volume and a lot of interest in it, so it charts very, very nicely. Now, one of the things that we can see on the left-hand side here is that if we look at the bear market from fall of 2007 to the bottom, the current bottom in March of 2009, we see a strong bounce off there, and it's already retraced not only 38% of it, 50% of it, but also closing in on the 61.8% retracement at 1228. Now, the reason that that's important is because once charts close above the 61.8% retracement, the probabilities have then increased for a complete filling of the triangle at that point. So charts can bounce up to and then fall back from the 38.2, the 50%, or even as high as the 61.8. There's the possibility that the chart will fail here, fall right over, and then it's right back into a bear market, which would, I think, surprise the greatest number of traders at this point. I don't personally see that happening, but we still have to keep it open as an option right now until that price is able to close above the 61.8% retracement at S&P 1228. So as you can see, this is an extremely important level that the S&P has got to either get up and above, or we're going to see it fade down. Now, the problem that I have with that right now is looking at the weekly chart. The weekly chart is showing that it's gone up wave 1, down wave 2, up wave 3, down wave 4, and is in the current ending wave 5. Typically, most of these trends don't last more than 5 waves. So if this is the finishing wave, perhaps we'll see that 1200, perhaps we'll get up to that 1228, which is what I call my ultimate target. But what's going to happen after that, I think, is what's so interesting. So we have 3 possibilities at this point. Possibility 1 is that the chart just keeps on rising and treats S&P 1228 as though it just didn't even exist, kind of like it did with the S&P 1200 the other day. And so wave 5 is extremely strong, and we end up well above that 61.8% retracement. So that's possibility number 1. Possibility number 2 is that the price is not able to penetrate that 1228, and what happens is that we at least start an ABC correction, which would look something like this, or perhaps even the beginning of a 5-wave series to the downside. And that would look something like this. The first thing that we'd see is a wave down that would take out the prior swing low and go lower than that, pull up to a lower high, and then the wave 3 down would kick in. So we'll know whether or not that's going to happen based on whether this first wave actually takes out this prior swing low, which is right around the 1050 level on the S&P. Now, the third possibility, and the one that I think is probably most likely to occur, is that stocks move into a consolidation zone up at this level. Now, the reason why I think this might occur is because of this particular indicator that I've been tracking for some time is just showing whether or not stocks have consolidated or whether they're finished with a trend. So this indicator shows whether or not, if it's a very high value above 55 or 60, shows that there's a high degree of consolidation and stocks are ready to move. You can see that this occurred up at the top in late 2007. We had a lot of chopping around up at this level. We had a very high value above 60. That was showing that stocks were ready to trend, and certainly we did trend. Now when the price gets, or with this indicator goes below 35, that's saying that this trend has pretty much run course, and that's what we saw near the end of 2008. From there, we did get some consolidation as we got through the latter part of 2009, but since then we've been in a very linear trend, and on the monthly chart this is a very, very low value of 28. That's showing we've had an extremely strong linear trend up off the bottom, and this trend has worn itself out. Now we can see double confirmation of this if we look at one time frame down, which is the weekly chart. So we can see that near the end of 2009, charts were in extremely strong consolidation mode because they sat in that horizontal pattern for several weeks. The value got above 60 on this indicator, and since then we've had what amounts to a very strong linear trend, especially as we've gotten in through the beginning part of February. You can see that, and now that we're below 35 again on this indicator, showing that this trend as well has worn itself out. So what we might see is, again, an extended period of consolidation at this level as both of these indicators work themselves slowly back up to above 55. This will obviously happen much faster on the weekly chart, but this will take some time, certainly a couple of months, before it'll work itself back above the 55 level and be ready for another weekly trend. Now, as we look at the major index charts on a daily basis, Friday was certainly a scary day with Goldman Sachs news, but none of the trend lines have broken. This is the S&P. Here's the Russell 2000 daily chart. And here is the Dow daily chart. None of these trend lines have broken to the upside. Eventually it will happen, but probably because it's moving into a sideways consolidation period. Now let's see how our current positions are doing. After another profitable options cycle for April, all we have currently is May positions. And so this is my May high probability Iron Condor. You notice it looks a little different because we did have to add a positive delta hedge trade. So it's kind of kicked up on its side, and you can see that this will help us if the price decides to keep rising higher. And you can see our delta neutral or low probability Iron Condor, which is based on the XSP. Price is right near the center of the condor. We have hedged it off to the upside by butterflying off the call spreads in case we get an extended move to the upside. So this one's also looking fine. And because of the fact that we've had very low implied volatility lately, chances have improved to see a spike higher in implied volatility. So what we decided to open was a double calendar position, which is long Vega. Now what that means is that we're looking for an event to cause a spike in implied volatility, and this is the type of trade that would take advantage of something like that. So it looks like our timing was good for that with the bad news that came out on Friday, and we may see some continued implied volatility rising throughout the market until that event has been taken care of. And that's it for this weekend, folks. Have a terrific rest of the weekend and enjoy the spring. See you next week.